advocate on behalf of industry issues.
Convince trust and asset management companies to adopt the Asset Managers Code and the Global Investment Performance Standards.
Let's put ethics at the heart of everything we do. Talk about ethical decision-making.
Encourage ethical behavior and be really passionate about it.
Let's create an environment where investors' interests can flourish.
Markets function at their best and economies grow.
For the ultimate benefit of the Philippine society.
I am Chris Arceo.
Mark Yu.
Erwin Ocampo Avante.
Rob Ramos.
Sandra Aurelio Gonzalez.
Mark Ilaw.
Kate Burgos, and I am CFA Charter.
We
measured up. Join us.
Let's measure up.
CFA Institute is a global association of investment professionals that sets the standard for excellence in the industry. Since its foundation in 1947, CFA Institute has aggregated about 100,000 members and candidates in the fastest growing region, Asia Pacific. In response to extensive demands, CFA Institute has created the Asia Pacific Research Exchange, or ARX, an online research platform focused on investment management. Covering 18 major markets in the region, ARX provides content on over 20 investment subjects, including within the fields of knowledge application, academics, and regulation. Leveraging the extensive membership network and industry resources of CFA Institute, ARX is a sharing platform, feeding its users a great deal of first-hand industry news. ARX is also a learning platform, as a large number of high-quality research papers enable its users to stay abreast of all popular investment topics in the region. Beyond all that, ARX users can hear each other and find industry peers by publishing articles and research reports, making it a highly interactive platform. For more details, please visit www.arx.cfa. ARX is your preferred financial research platform for sharing, learning, and interacting.
Good afternoon, everyone. Welcome to the Investor Series Real Estate Investment Trust Fund webinar. Thank you for being here today with us. My name is Monzen Malyari, and I am your host for today's online event. We would like to take this opportunity to recognize our annual corporate sponsors. Platinum sponsor, COL Philippines Incorporated. Silver sponsors, BDO Capital, Coco Life Asset Management Company, Incorporated, and FTI Consulting Philippines, Incorporated. And bronze sponsors, AP Securities Incorporated, DPP Daiwa Capital Markets Philippines Incorporated, and Papa Securities Corporation. Event partners are FMAP, MART, and ShareFill. To formally welcome us all, may we please have the President and Chairman of CFA Society Philippines Incorporated, Dr. Robert Ramos, CFA, CAIA, CIPM.
Thank you very much for the warm introduction, Monzen. It's a pleasure to be here. Thank you for joining us in this investor series. I think one thing that's very important, it stood out to me during the pandemic, and as we transition out, how can we make ourselves better? It's making sure that we continuously learn. We continuously get new information. We continuously incorporate this information that we learn into our lives, into our actions. And hopefully this information would lead us to be better persons, making better decisions. What's the best way to learn? The best way to learn is to listen to the experts of the field. And I'm very, very happy to learn from one of the best. Also, Mr. Raul Ruiz is the president of RCBC Securities, and he's also a CFA charter holder. So who more can we get such great information from but himself? I hope that you will continue to join us in this investor series and pick up great learnings from our esteemed speakers. So welcome and thank you for joining. Monzen, back to you.
Thank you, Dr. Robert Ramos, for the warm welcome. Again, welcome to the webinar. This webinar is brought to you by CFA Society Philippines. Before I introduce the speaker, may I remind everyone that you may submit your questions via the chat box in Zoom. Joining us today to talk about the Real Estate Investment Trust Fund is the president of RCBC Securities, or RSEC, since November 2019, and the head of RSEC Research from 2010 to 2021. Before RSEC, he headed equities research for 3 foreign-based stock brokerage houses in the Philippines for 11 years. He headed business development for an Israel-based multinational company, Africa Israel Investments Philippines Incorporated, and was involved in originating, negotiating, evaluating, and closing direct equity investment deals in real estate, tourism, power, and infrastructure projects in the Philippines. Concurrently, he is the professor of finance at the Ateneo Graduate School of Business since 2002. He was also professor of economics at the De La Salle Graduate School of Business from 2001 to 2011. He started his career as an investment analyst in the trust banking group of the former Far East Bank and Trust Corporation, then the largest asset management company in the Philippines. He holds a BA in economics, magna cum laude, and an MBA, both from UP Diliman. He has passed the 3 Chartered Financial Analyst exam levels in 2004. He attended the Trust and Investment Management course of the American Bankers Association, held at Kellogg School of Business, Northwestern University, Illinois, and he topped the Trust and Investment Management course of the Philippine Trust Institute, the educational arm of the Trust Officers Association of the Philippines. Without further ado, may we call on the president of RCBC Securities, Mr. Raul Ruiz, CFA.
Thank you very much, Monsen. Thank you for that generous introduction. And thank you, Rob, for your welcome remarks. I'm very happy to be here. Good afternoon, everybody. So I'm very pleased to be here, and for that, I thank CFA Philippines. I have been invited to speak about the basics of REITs, primarily as an investment vehicle. And I don't really know how to draw the line between what is basic and what is advanced. So I guess my only request is for you to, at any point during my presentation, if you have questions, please raise them through the chat box, and I would gladly answer them before we proceed, because I would like you to be able to maximize your learning from this presentation, and I don't want anybody to get lost in the middle of the presentation. So without further ado, let me share with you my screen.
We can see the screen.
So I'll present I'll present an overview of REITs and the case of the Philippines. I will start with a backgrounder on REITs, and then I will discuss the different point of views from which REITs can be looked at, depending on the hat that you're taking. And then the next sections will basically discuss REITs from the point of view of an investor, or considering that most of you here are probably CFA members, then from the point of view of an analyst who has been asked to evaluate a REIT investment by an investing client. And from that point of view, you need to be familiar with the characteristics of a REIT, the factors that may affect the price of a REIT, how to analyze REITs, and how to estimate the fair market value for REITs. And then I will conclude with a quick look at the REITs that are available in the Philippine market. Now, the importance of understanding REITs was well illustrated by what happened to A-REIT, the country's first REIT, when it was offered through an IPO in July 2020. The REIT was offered at an IPO price of 27 pesos per share, for those of you who remember. And based on our forecast, that would earn a full year dividend yield of 5.7% in 2021. Because remember, the REIT offer was conducted sometime July 2020. And therefore, for us analysts, we only look at the year ahead. And for this one, the full year was the full year of 2021. So based on 2021 dividend yield, it was 5.7%. And we believe that to be attractive in comparison with the yields on bonds, common shares, and preferred shares during that time. Now, however, despite that, the REIT, if you know, fell by almost 12% in 2 days since listing. And what it seemed to us was that a lot of investors look at the REIT as similar to any IPOs that can be flipped on listing. And therefore, many investors subscribed without having long-term holding power and consequently dumped the REIT on listing. And as everybody was dumping the REIT shares, nobody was supporting it at the bottom. And for me, and for all those who are familiar with REITs even at that time, this was a mistake because REITs have been designed to earn dividend income and not appreciate in price over time. So that lack of appreciation of what REITs are turned out to be costly to a lot of investors buying a REIT for the first time. So with that, here's hoping that my presentation will help you to avoid the fate of those who lost money from a REIT. But let me just begin with a brief history of REITs. I hate to admit it, but REITs are just a few years older than I am. So they were first introduced in the US in 1960, enabled by a legislation signed by then US President Dwight Eisenhower. And then the first REIT in the US was introduced in 1961. And then from that time onwards, the REIT market did not progress so much. It eventually was adopted in a few markets like the Netherlands, but it did not progress so much until 2001 when it was introduced in Japan. And from that time onwards to the present, there are already around 40 countries that offer REIT products. And the US model served as a template for all these REITs. Now, in the Philippines, on the other hand, Republic Act number 9856, or the Real Estate Investment Trust Act, was signed into law in 2009 during the time of President Gloria Macapagal Arroyo. And that REIT Act, at least for the Philippines, defined what REITs are supposed to be. So they are corporations established principally for the purpose of owning income-generating real estate assets. And in that definition, there are a few ideas that I'd like to highlight and explain. So the first one is a REIT is a stock corporation. So it has to be registered with the SEC as a corporation. And upon registration, it therefore becomes a person unto itself that is separate from the personalities of the shareholders. So the second important idea is that it owns income-generating real estate assets. So not just any real estate asset, but an asset that is able to generate recurring income. And for all intents and purposes, that referred to rental income. All right. So those real estate assets may be office buildings, they may be malls or other commercial spaces, they may be hotels, or they may just be land that is being leased to a tenant, and the tenant is using it for other purposes besides real estate. And then the second important idea under the REIT Act is that it shows or it provides for investments in REITs to be made available by way of buying the shares of stock of the REIT corporation. Now, despite the REIT Act being signed into law in 2009, it wasn't until February 2020 when the implementing rules and regulations of the REIT Act were released. No? And that lengthy time lag was a result of disagreements among the stakeholders, primarily the real estate developers and the regulators, including the BIR, on the minimum public float, reinvestment requirements, as well as tax issues concerning REITs. So finally, when the IRR of the REIT Act was released in February 2020, then Ayala Land was able to introduce to the market the first Philippine REIT offering, which is the Ayala Land REIT that had an IPO in July 2020 and was listed sometime in August. Now, in comparison with the ASEAN region, the Philippine REIT market is obviously a baby. No? So the ASEAN REITs have been available since 2002. And if you compare the Philippine REIT market with a market capitalization of $4.9 billion as of May 26, with similar REITs in other ASEAN markets, you can see that it trails behind, particularly Singapore, which has a market capitalization of $72 billion. And even in comparison with the Philippine stock market alone, the market capitalization of REITs represent only 1.5% of the PSE's total market cap. Now, this table just shows you how REITs performed in the region in comparison with their corresponding equity markets, only for your information. No? So we are still too early in the presentation to be drawing conclusions from this table, although I would think that by the end of this lecture, we should be able to do that. But in any case, for now, if you take a look, for example, at the top rows, you have there the Singapore REIT index and the Australian REIT index. And in comparison with the Singapore market below, as well as the Australian market below, the REIT markets in these countries actually perform worse than their corresponding or counterpart equity markets. On the other hand, if you look at the Hang Seng REIT index and the Tokyo Stock Exchange REIT index, they perform better in comparison with their counterpart equity markets. As for the Philippines, since there is no Philippine REIT index yet, we can take a look at one of the REITs, such as A-REIT, and if you compare that with the PSEI, on a year-on-year basis, A-REIT has in fact beaten the Philippine Stock Exchange, but in other periods, it has underperformed. Okay. So this is just to show you how REIT investors are probably situated now relative to the market, as well as relative to their other investments. Now, there are different stakeholders that are involved in REIT issuances, and each of these shareholders or stakeholders, will have a different perspective on REITs. So for example, the regulator, in our case, that would be the SEC and the PSE, would be interested in REITs as a way of deepening the capital market, because a REIT, after all, is an additional investment product available to the public. At the same time, it is also an additional way by which real estate developers can raise capital from the capital markets. From the point of view of real estate companies, they can look at REITs as allowing them to monetize their real estate assets and consequently give them the proceeds to be able to reinvest in real estate projects, allowing them to grow further. Now, in addition, as we probably know already, REITs are also a tax-saving vehicle for these real estate developers. From the perspective of the underwriter, an underwriter will want to win the deal in order to be able to underwrite these REIT offers by issuing companies, but at the same time, they would like to be able to ensure that they will be able to sell those REIT issuances to the public. And then finally, from the point of view of investors, a REIT is an alternative investment vehicle, and therefore they will have to assess the expected return as well as the risk of the REIT investment in order to make an investment decision at the end of the day. Now, in the Philippines, the regulators have established a set of criteria to qualify as a REIT that prospective issuing real estate developers need to comply with. No? And as I said, some of these regulators are the SEC, the PSC, and the BIR. These criteria pertain to the size of the REIT, the public float, the management, the use of proceeds by the issuing real estate developer, the investments, as well as the dividends that will have to be paid by the REIT. The SEC, for example, requires that a REIT corporation has a minimum paid up capital of 300 million. And in terms of public float, the REIT must be listed with an exchange, and it must have at least 1,000 shareholders upon listing. And in the aggregate, the public has to hold at least 1/3 of the outstanding capital stock of the REIT corporation. A REIT is also required to appoint a fund manager and a property manager. The fund manager will have to manage the investments of the REIT corporation, while the property manager takes care of the day-to-day operations of the real estate assets. Proceeds from the IPO may only be reinvested by the issuing developer, also called the sponsor, in income-generating assets within the Philippines. And the sponsor has 1 year from the receipt of proceeds to have those IPO proceeds fully invested. At least 75% of the gross income of the REIT must come from real estate, including real estate mortgage assets. And what is probably the most relevant to REIT investors is that the REIT is required to distribute at least 90% of its annual distributable income as dividends to its shareholders. From the point of view of the issuing real estate developer, he is interested in REITs because there are benefits to issuing REITs. No? The company spinning off its income-producing assets in order to form and issue a REIT, which we technically call the sponsor, enjoys tax savings, no? Because dividends that are paid from the REITs qualify as a deduction from taxable income, no? And therefore, you have a tax benefit, or at least the sponsor enjoys a tax benefit from the REIT issuance. Now, let me pause for a while and just throw these two questions to the audience. The first one is, why does the government require a minimum public float for REITs? And the second is, why does the government require reinvestment of IPO proceeds only within the Philippines? Although these are two questions, they can actually be answered by just one answer. So I'd be interested to hear from anybody if you would like to answer these questions. Anyone? Would anybody like to be heard?
No, I mean, the minimum float, isn't it standard for other equity investments?
Well, there's a minimum public float for common shares as well, no? Although it's not 30%. But yeah, well, in general, you can in fact word this. You can in fact rephrase this to ask, why does the government in fact require a minimum public float at all? No, not just for REITs, but for equity investments as a whole. Anyone? Going, gone.
There's an answer in the chat.
All right, so let me answer that question that I asked myself. No, the government, of course, has among its objectives the objective of giving the public access to investing in real estate, no? Considering, because it recognizes that the real estate industry is a profitable industry. And second, it also recognizes the ability of the real estate industry to spur economic growth, no, or economic expansion. So considering those two, then it looks at REITs as being able to address those two considerations. No? So REITs can be a vehicle for the public to be able to invest in the real estate industry. At the same time, by being able to invest in REITs, then the public are able to help the real estate industry grow by way of their investments. Now, in order for the government to make REITs attractive, then it has to incentivize real estate developers to issue REITs, no? And therefore, the tax savings that issuing real estate developers can benefit from if they issue REITs. Now, those tax savings are obviously a cost to the government. And for the government to be able to recoup that cost, then it has to require this minimum public float as well as this reinvestment of IPO proceeds within the Philippines. So that in that way, it can ensure that the public, in fact, are able to enjoy the benefit of investing in a real estate asset and at the same time, help with spurring economic growth. All right, so from the point of view of investment banks, on the other hand, as I already mentioned, they're interested to win the deal, to package and sell REITs. No? Therefore, they will seek to maximize the REIT proceeds that they will commit to the issuing real estate developer, but at the same time ensuring that they will be able to sell the entire issue to the public. No? So besides that, the investment bank should also be able to handhold the issuer throughout the listing process, and they should also have a big enough client base to be able to sell the issue. No? And as you can see, investment banks like BDO Capital, First Metro Investment, and if I may add, RCBC Capital have big enough client bases in order to be able to sell REITs to the public. And then finally, from the point of view of the investing public, the most important question is, of course, whether they should buy a REIT investment or not. And by investing public, I don't only refer to retail investors like you and me, but that may also include big institutional fund managers like GSIS and SSS, mutual fund managers like Sun Life Asset Management, and even trading participants or brokers like RCBC Securities, who have analysts who will have to evaluate whether to recommend REIT investments to their clients or not. So for investors and analysts to assess the attraction of REITs as an investment, one of the things they have to know first are the characteristics of our REITs. And these are best appreciated by comparing them with preferred shares and common shares. So in comparison with preferred shares, we already know that REITs distributable income has to be paid out as dividends to the extent of at least 90%. On the other hand, preferred shares are not required to declare dividends unless and until dividends are declared by the board of directors. Not everybody is aware of this, no? But even though companies may issue preferred shares and they will claim that those preferred shares are supposed to pay, for example, 5.5% per annum, that 5.5% per annum is by no means not guaranteed, no? And investors will not be able to run after these companies if they're not able to declare dividends, no? Because dividends are not a liability of a corporation by law unless and until those dividends are declared by the company's board of directors. Now, on the other hand, for REITs, as I mentioned, REITs have to distribute at least 90% of their distributable income as dividends. So that makes dividends on REITs more reliable than dividends on preferred shares. Second, dividends on a REIT are a function of a REIT's income and may grow over time as income grows. Okay, so as I said, dividends are at least 90% of REIT's distributable income. And for so long as the income of the REIT grows over time, then the dividends on the REIT may also grow over time. In contrast, dividends on preferreds are typically fixed, no, and measured as a percent of par value. So as an example I earlier cited, if a preferred stock is supposed to pay 5.5% per annum, then that 5.5% is based on the par value of the preferred stock. Okay, so it therefore is a fixed amount because the par value of the preferred is also fixed. Third is Philippine REITs have no redemption feature. On the other hand, preferreds may be redeemable, and that gives rise to reinvestment risk, no? Because the chances of a preferred stock being redeemed increases as interest rates fall. And therefore, if you are a preferred shareholder, when a preferred share is redeemed at lower interest rates, then you are at risk of reinvesting your money at lower interest rates. Fourth, Philippine REITs are more liquid than preferreds, making them easier to buy and sell. So I can only speak about this as far as the Philippine market is concerned. So I can say with certainty that most, if not all, Philippine REITs are more liquid than listed preferred shares, and that makes them more tradable. However, fifth point is because of this liquidity, that results in a more volatile price than that of a preferred stock. So if you compare how the price of listed preferred shares move with REIT shares, you will find that REIT shares actually move more volatile than preferred shares. On the other hand, comparing REITs with common shares, as we know already, REITs provide a tax benefit to the issuer that common shares don't. Second point is that dividends on REITs are more reliable, and we have already discussed this when comparing dividends on REITs with dividends on preferreds. They are more reliable than those on common shares. Now, for the same reason, dividends on common shares are not a liability of the corporation until declared by the board of directors. And then third point, in comparison with the common shares of property companies, on the other hand, REITs income is less volatile because they consist primarily of rental income. On the other hand, you probably know that property companies mostly have real estate sales among their sources of income, and this will be more volatile depending on the cyclicality of the real estate market, as well as on the demand or appetite for particular real estate products. Now, however, there are certain cons to REITs in comparison with common shares. No? That steadiness in REIT income also implies more modest income growth over time versus that of non-REIT corporations. Okay, so even though REIT income is steady, the growth will probably only be in the single digit over time, no? Against income of non-REIT corporations, which may be in the double digits. Second, the requirement on dividend distribution limits the ability of REITs to reinvest their earnings. No? So because of that requirement to pay out at least 90% of their earnings, then at best, they can only reinvest 10% of their earnings year in and year out. And as a result, that would act as a constraint on reinvestment for faster future growth. So all considered, this limited growth prospect caps the share price upside potential of REITs. Next, as an analyst or an investor, you also have to know the factors affecting the price of a REIT. The first one I would like to discuss is organic earnings and dividend growth. No? So dividend growth follows from earnings growth. Again, because of the requirement that 90% of earnings have to be paid out as dividends. No? And therefore, dividends will only grow to the extent that earnings grow. Now, of course, the company or the REIT may decide to distribute more than 90% of its earnings as dividends, but that will cap future earnings growth going forward. Now, in turn, earnings growth will hinge mostly on rent escalation, which in the best of times will probably be only a maximum of 15% per annum, increase in occupancy rates, and cost management. Another potential source of growth is asset injection. So any REIT sponsor which would like to see the price of its REIT issue increase may decide to inject additional assets into the REIT security. Now, however, in most cases, the injection of a REIT asset will, I think it goes without saying, require a payment. A sponsor or a real estate developer that's going to carve off some of its real estate assets in favor of a REIT will need to get paid back for those assets that it will inject into the REIT. And that payment may come in the form of additional new shares that real estate developer will own of that REIT company, or may actually involve cash payment as well. Now, if we look only at the issuance of additional new shares, then that will offset the potential increase in earnings. So, as you may know, when we're evaluating equities, we look at earnings per share as one of the measures. And in this case, if you issue more shares, even though earnings will go up, the additional shares will also reduce your earnings per share. So as an analyst or as an investor, it is important for you to analyze whether the asset injection will be accretive to earnings or dilutive to earnings. If you take the example of the recent Ali Arid property for share swap, where Ayala Land injected 6 Cebu office buildings in favor of AREIT with a GLA or gross leasable area of 124,299 square meters, and which it valued at 11.258 billion pesos. As a result of that injection, AREIT will have to issue 252.136 million new shares to Ayala Land. And that will increase the outstanding shares of AREIT by 16.7% more. Okay? Proportionately reducing earnings per share, depending on the additional earnings that will come from the asset injection. So considering that example, I have a few questions for you guys. So the first one is, under the foregoing property for share swap between Ali and AREIT, at what price was AREIT valued? Can anybody answer that? So Ayala Land injected 11.258 billion pesos worth of real estate assets into AREIT, and in turn, AREIT will have to pay with 252.136 million new AREIT shares. So effectively, that prices AREIT at 11.258 billion divided by 252.136 million new AREIT shares, right? Mm-hmm. So your answer is 44.65. So I'm sorry, I shouldn't have answered that for you guys, but there it is. Now, next question. What was the price of AREIT around that time? So the disclosure on the property for share swap was released. When was that released? Okay, I forgot already. But let us take a look at the price of AREIT. On the day before the disclosure was released. All right, so there you have it. So the disclosure was released on March 18, and the day before the disclosure, the price of AREIT was 45.75. And that is 2.4% below AREIT's valuation under the property for share swap deal. So if you compare the 45.75 with the 44.65 pesos valuation of AREIT, then you can see that the 44.65 is 2.4% below the 45.75. And then last question on this one. How did the price of AREIT move after the disclosure? It trended modestly higher, hit a high of 47 in the next couple of weeks. And that is better appreciated by looking at this price chart of AREIT. So from May, or was that May or March? From March 17 onwards, you can see the uptrending green line showing you the increase in the price of AREIT after the disclosure. No? Now, don't get distracted by the sharp drop from this time going forward. I don't think that had anything to do with the property share swap and had more to do with the incoming elections as well as the prospect of rising interest rates. No? So that was market-wide rather than specific to AREIT. And then an additional factor affecting the pricing of REIT is relative yields. No? And this is relevant. This has become especially relevant now, considering the prospect of rising interest rates, not least over the next 2 years. So with market interest rates rising or expected to rise by 1 to 3 percentage points over the next 2 years, then you have to compare the current dividend yields that are being offered by these REITs with the potential yields that could be available from other fixed income investments. And the problem is the potential rise in interest rates may be higher or faster than the ability of dividends on REITs to catch up. Now, because as we have learned, dividends on REITs can only grow in step with growth in its income. No? And that is constrained by the requirement to declare 90% of its income as dividends. All right, so I'm moving on now to how to analyze REITs and how to estimate the fair market value of REITs, which will help us arrive at the recommendation as to whether or not to buy specific REIT investments. And in analyzing REITs, the most important and the first thing that you'll need to do is to read the REIT plan. So the REIT plan is similar to the prospectus that is available for IPOs of common shares. And this contains, among others, the terms of the offer and information about the REIT sponsor, the fund and property managers, the sources of income of the REIT and the nature of the sources of income, the financial position of the REIT, as well as the prospects for future growth of the REIT. The next step is to have a forecast of future earnings, funds from operations, and dividends. No? And I'm using here the word have because not all of you may want to or may be able to forecast on your own. No? So for so long as you get hold of a forecast, whether that is a forecast from a broker who services you or a forecast from the underwriting investment bank, of course, those forecasts may differ from one to the other, no? So it's best to maybe look at a consensus forecast. So just get hold of a forecast, not just of future earnings, no, but for REITs, forecasts of funds from operations is more relevant. No? And funds from operations merely adjust for for depreciation and amortization, as well as expected capital expenditures, no? Because that is going to be the basis of the dividends that the REIT may pay out. And then final step is to calculate and analyze the financial ratios and use valuation metrics, no? Just as you would with common shares and other investments in general, but some financial ratios and some valuation metrics may be specific for REITs in particular. So let me just discuss some of these more commonly used valuation metrics for REIT investments. So the first are relative dividend yields. The second is the net asset valuation method. The third is the discounted cash flow model or the discounted cash flow method. And the fourth is the dividend discount model. So for relative dividend yields, you should be able to estimate the future 12-month forward dividend per share and divide that by the market price to be able to get dividend yield. So for any REIT investment, you should be able to forecast the 12-month forward dividend per share. And if you divide that by the price at which you're considering to buy the REIT investment, then you get the dividend yield. And you simply compare that dividend yield with the dividend yields of other REITs as well as the dividend yields of other investments, or for that matter, the yields on alternative investments, including interest earning investments. Now, the second method is more demanding, and this is the net asset valuation model. This is the net asset valuation method, but this is something that we also learn in CFA. So hopefully you're not a stranger to this yourselves. But for a REIT specifically, it requires valuing the REIT assets at market. And you can either do that by using appraised values, which will require the appraisal of a professional appraiser, or alternatively, you can forecast the net operating income of the REIT, and then you divide that by the cap rate. Now, I'll explain what the cap rate is in the next slide. Now, after you do that, you deduct the maintenance capex, as well as the overhead capex, as well as the overhead expense capitalized at the cap rate. And then you add other assets such as cash at book value, and you deduct liabilities as well as preferred shares also at book value. Now, some may prefer to value liabilities at market, but the market value of liabilities are usually close to their book value anyway, and therefore it probably will not differ much, whether you choose to use liabilities at market value or liabilities at book value. That will give you the net asset value. And then the next step is to divide the net asset value by the number of shares outstanding to get net asset value per share, or NAV per share. And the decision rule is to buy or to recommend purchase if the market price of the REIT is lower than or at most equal to the estimated NAV per share. But the higher the margin of safety, or the greater is the discount of the market price over the estimated fair value, then the better. So the cap rate, or the capitalization rate, is the rate that is used to get the market value of a real estate asset based on its forecasted net operating income. So the formula is cap rate equals net operating income over market value of property. Now, to apply this for REIT investment, however, or for analyzing REITs, however, you have to be able to have the cap rate for various properties, and that will require having the net operating income as well as market values of these properties, so that you can calculate the cap rates for these different properties and use them as basis. Now, for analyzing REIT investments in the Philippines, usually in practice, I know that we use cap rates ranging from 4% to 6%, depending on the type of property asset. And then the next method is the discounted cash flow method. So this is no different from the discounted cash flow method that we learned in CFA. You need to forecast future free cash flows from the REIT over its lifetime, considering the REIT as the corporation. And then you discount the FCFs to the present at the cost of capital. So where the cost of capital may either be the cost of equity or the weighted average cost of capital WACC. And then finally, the dividend discount model, which is different from the discounted cash flow model in the sense that it only forecasts the dividends that will be paid by the REIT. So it doesn't require forecasting the future cash flows as well as the funds from operations of the REIT, although perhaps you will not be able to forecast dividends anyway if you don't forecast earnings as well as funds from operations. So you may have to do the former anyway. But in any case, this one requires only forecasting future dividends and discounting them at the cost of equity. And the decision rule is to buy if the price of the REIT is lower than or at most equal to the sum of the present values. Again, the greater the discount, then the better. So mathematically, this is your formula. You only need to get the dividends over time and discount them to the present, and get the summation of all those. Now, again, for those reviewing for the CFA, they may have already encountered the concept of constant growth or Gordon growth model, no? In which case you may have to forecast dividends at different stages, and then in the end forecast the terminal value using the Gordon growth model. Okay, so finally, let me just show you what are the available REITs in the Philippine market, and perhaps compare them with one another. So these are the available REITs, arranged from the earliest listing all the way to the most recent listing. In fact, I only have here, Vista REIT here has just started its offer period today, and therefore it's not listed yet. No? But besides that, there are currently 6 listed REITs, from A REIT to Double Dragon REIT to Philinvest REIT to Robinson's Commercial REIT, Megaworld REIT, and Citicorp REIT. Citicorp REIT. And you can see here, basically just a rundown of what the properties are, no, but these are just general descriptions, obviously, of what they are. So AREIT has 15 office buildings in its portfolio, 3 mixed-use developments, and 1 industrial lot. Double Dragon REIT has 3 commercial properties plus land. By the way, which brings me to an important point as well, that REITs may not have land in its portfolio, but instead just the improvements on the land, in which case you are not looking at potential appreciation of the value of the land. Philinvest REIT has 17 office buildings. RL Commercial REIT has 16 office buildings. M REIT has 18 office buildings. Citicorp REIT is unique because instead of real properties, it has a solar power plant, no, on which stand on 7 parcels of land, no, and Citicorp earns from rental on the land that is being leased out. And then the upcoming Vista REIT has 10 community-based malls and 2 office buildings. Okay. So of course, it's not enough to know how many office buildings or how many malls these REITs have. It's more important to know how many in square meters they are leasing out. No? So GLA is very important. And you can see that in terms of GLA, Citicorp is the biggest, but remember that these are actually just land on which the solar panels are built on, whereas the others are being rented out to office as well as commercial tenants. And then this is the current price of these REITs in the Philippine Stock Exchange. So A REIT traded at 40.75 as of last Friday, and so on. And then the last column shows you what the target prices of RCBC securities is, no, for these different REITs. And I think based on a comparison between the current prices and our target prices, you can probably guess that we have a buy recommendation on all these REIT products. We cannot, however, issue a recommendation on Vista REIT because RCBC Capital is a participating underwriter. So the REITs that are available in the Philippines are predominantly exposed to the Philippine office market. You can see that 67% of these REITs have office market exposure, while 27% are diversified, and then 6%, which pertains only to Citicorp REIT, is invested in solar power plants. And in terms of dividend yields forecasted for this year as well as next year, the average dividend yield on REITs is 6.4%. And you can see here which REITs offer a lower dividend yield and which offer a higher dividend yield. And similarly for 2023, you can see which REITs offer lower dividend than the average of 6.9 and which REITs offer a higher dividend yield than the average. And then this shows you the comparative dividend yields, not only of Philippine REITs, but also of common shares of property companies. So starting with Vista REIT, promising the highest dividend yield of 8.2%, and going down all the way to SM Prime Holdings, which has the lowest forecasted dividend yield of 0.3%. So this is just a disclaimer that we are not issuing this for purposes of soliciting business, but only for your information. And we are on social media, so we encourage you to engage with us. Thank you very much. So I'm now open to your questions. By the way, I'm not sure if I mentioned, I also have with me our property analyst and REIT specialist, Francis Zamorano, to answer your questions if in case they are too complicated for me to answer.
All right. Thank you, Mr. Ruiz. Yes, we will proceed with the Q&A session. We call on Mr. Ruiz and Ms. Zamorano, so if they can answer the questions. To the audience, please write your comments or questions in the public chat space. You may also raise your hand in the chat box as well. It's there. Actually, we got our first question. It is from Juliet. Thank you for that. I guess you've provided your forecast as well, but in short, which do you think among the available REITs is the best local REIT to invest in?
Okay, so that is something I'd rather have the REIT specialist, our REIT analyst answer. So Frances, can you answer that question?
Ms. Frances?
Hi, good afternoon. Yeah, so, well, right now, AREIT is looking really attractive to me. Well, the price is down by almost 18% year to date, and it dropped even further today, actually, which has made its dividend yield relatively even more attractive versus when its price was hovering at around 50 pesos per share. Plus, its recent property per share swap will also boost its portfolio by 23% with the infusion of the 6 office assets from Ali. Those assets, by the way, have healthy occupancy rate of 97%, and they also have the properties also have a higher yield relative to its existing portfolio prior to the swap, which makes the acquisition dividend yield attractive for investors despite the issuance of shares.
All right. We didn't catch the name. Which one is it?
Sorry, AREIT.
AREIT. Got it. So to Ms. Juliet, AREIT currently is the most recommended among the available REITs. We got a few other questions. Let's go to the question by Robert Ramos. Thanks, Robert. What's the differentiation of our local REITs compared to regional and international REITs in terms of risk, yield, diversification? And I guess I'll add my question as well. Is there a comparable difference in terms of regulation in the Philippines versus ASEAN, for example?
Frances, can you answer that question?
How does yield
in comparison with risk and yield, no? Well, this is a very hard question because you have to look at the individual REITs, so it is difficult to generalize. You did see earlier, I think, that the yields on, for example, Singapore REITs are actually higher than the REITs on Philippine REITs. But again, you also need to consider the growth prospects as well as the exposure, no? Because REITs, even within the same country or even within the same domicile, will have different exposures, no? So it's almost like comparing apples with oranges, no? And obviously, you'll have to be able to compare apples with apples. And that would entail looking at a specific risk, at a specific REIT in a specific domicile with another specific REIT in, let us say, the Philippines. Again, because one REIT can vary widely in terms of exposure, and consequently in terms of growth prospects as well as dividend yield. Can differ from one to the other.
If I may
Do you have
also
anything to
add,
contribute, Francis?
if I may also add, since in the ASEAN region, Singapore is the, I would say, most mature REIT market, and they have definitely a more diverse exposure into different sectors. If in the Philippines, we are still primarily, the REITs are primarily exposed to the office market. In the case of Singapore, they have REITs on malls, healthcare, hospitals, hospitality, and more. So I would say that is a striking difference between Singapore REITs and the local REIT market.
Yeah, and of course that has to do, of course, with the infancy of the Philippine REIT market in comparison with other countries' REIT markets. So the Singapore has had REITs since 2002, in comparison with the Philippines, which only started with REITs 2 years ago, and consequently, Singapore has many more REITs in comparison with the Philippines.
Got it. Definitely apples to oranges, but thank you for the comparisons. They are very insightful. Let's get to a more, I guess, a more detailed question from Carlos Garcia. He's asking about the REIT fund managers. Do they need to be separate from the developer themselves? Any particular, perhaps restrictions or maybe capital requirements when you compare the REIT versus the original property developer?
Yeah, again, Francis can answer that very well, I'm sure.
So the fund manager has to be a separate entity versus the property manager as well as the REIT, just to make sure that the transactions and the management of the REIT itself is they are managed well and at the best interest of with the best interest of the shareholders in mind.
Definitely. All right, thanks
Actually,
for that.
if I may add, under the implementing rules and regulations, the fund manager, in fact, has to be independent of the sponsor. No, but however, if you take a look at the composition of fund managers of Philippine REITs, you will find that most of them come from the sponsors. So they used to be connected as real estate professionals with the issuing corporation or the issuing real estate developer, and then were only subsequently redesignated to work in the fund management entity of the REIT corporation.
Thank you for that. That's great context. Let's move from a, I guess, a more detailed question to a more valuation related question, I suppose. This is from Arlene Gonzalez. You mentioned before that probably you're unable to comment on Vista REIT specifically, but she does ask that if Vista REIT has, say, the highest projected dividend yield, perhaps in general, what are the risk factors that could affect the realization of this yield, the dividend yield? What's the risk around the number itself, for example?
Okay, so for Vista REIT, downside risks are, first of all, in terms of the rental income and dividend distributions of the REIT, we have inflation risks right now top of mind, and so with that, if the recovery of consumer sentiment, consumer spending turns out to be slower than expected, then the variable portion of the REIT's income may be affected. Well, I don't know if this is still relevant, but if we see retightening of quarantine restrictions again, maybe a potential surge in cases again, that might affect the rental income of VREIT. Plus, VREIT also has about 18% of its leases up for expiry this year. And while there are ongoing negotiations for lease renewals for these, there's also a risk of lower distributions should any of these tenants choose not to renew with you.
Right. Let's parry, I suppose, the question by Joven Ray Panamogan. He's actually asking for a more general property outlook, given the FOMC rate rise rate at the meetings, the resumption of face-to-face classes. Does your property outlook in general differ from your REIT outlook?
Well, in terms of, am I referring to the right question here? Possible resumption of face-to-face classes and office workers going back on site.
Yes.
Yeah, that's the question.
So, with the reopening of the economy, this is definitely positive for the property sector, particularly commercial properties or and rental properties. In terms of how this relates to the REIT sector, particularly with office workers, we have issues between BPOs going back to work and some of them preferring to let go of their tax incentives to be able to continue working from home so that they're able to retain their employees. So these are some of the issues that I guess hound the outlook on the sector. In particular for REITs, we have, because of this particular issue with the BPO sector, there are some BPO companies that actually have chosen to downsize their office space requirements and has affected occupancy rates of some REITs. And so that is a risk, but there are also some REITs that have maintained their occupancy rates at a very healthy level, high 90s. So it's a mixed bag. No? Some are affected by these issues, some are relatively more shielded because of the nature of their tenants' operations. So actually, with regards to this, it's actually a mixed bag for the REITs.
All right, definitely a mixed bag, but you see opportunities in certain listings, for sure. Here's a more, I guess, an analyst question coming from Alvin Tan. Other than dividend yield, which you've shown as well, do you favor other multiples in terms of analyzing valuation of REITs?
Well, we could also look at the EBITDA multiples, given that you're focused on how efficient the REIT is generating its income. But primarily, we really look at dividend yield since this is the most relevant method or metric that we see that is most relevant for evaluating REITs.
That makes sense. Yep. All right. That's from an analyst perspective. Maybe let's move back to a more legal perspective. And Princess Riza Ong actually asks for something interesting. Can government REITs exist? Is it possible for a government agency with real estate mortgages to create REITs on their own?
Okay, this is a very scary question. So this is something that I think I would rather, have the regulators answer. As trading participants, we only look at what REITs are available in the market, and whenever they're made available, then we just take a look at them and analyze whether we should recommend them to clients or not. But this is obviously a regulatory question. It's probably something that, again, regulators, of course, are in the best position to answer, but probably even investment banks are in a better position to answer, because obviously investment banks will have to know whether they can in fact underwrite government agencies if they intend to issue REITs. Yeah, so unfortunately, Princess, I will have to pass on answering your question. I'm sorry. Unless Frances would like to, uh, unless Frances would know.
I defer this question, sir.
That's
Okay,
fair. That's a fair
sorry about
point.
that.
Yeah, that's a fair point. But I guess following up on that, how do you compare like current regulations versus others in ASEAN? You mentioned, for example, the minimum capital float, the other requirements. How does it compare to other ASEAN? And I guess the question is, given the prior experience wherein the REIT Act was passed in 2009, the IRR was passed in 2020, is it like a foreboding sign that if there's additional regulation, it may be difficult to implement or like to structure, or are we in the clear, quote unquote?
Yeah, well, at the end of the day, these were, well, the IRR was arrived at based on the agreement between the administration of that time with the real estate developers, and the administration changes over time. So to the extent that new administrations will not be in favor of the existing policies and would think about changing them, then obviously the policies may be in flux. Okay? And well, unfortunately for the Philippines, we all know that policies may change from one administration to the next. So there's no telling, of course, that the policies will stay at as is over time. But having said that, that is also true for any investments in the Philippines anyway. Tax rates may change, and requirements on issuances may also change depending on the administration. So there is obviously a political risk involved with REIT as with other investments.
All right, thanks for that. That is definitely a fair point. Let's move a little bit away from the legal side to, well, actually, it's still the legal side. The question by Pauline Villegas is, you mentioned the 90% has to be distributed as dividends. Is the 10% also still subject to the 25% corporate income tax, or what's the regulation around the 10%?
So for the remaining 10%, this would be subject to regular CI of 25%.
Ah, got it, got it. Okay, there is one more question in the chat, again from Juliet. Specifically, we go back to the property outlook. Do you have a specific commentary on property companies that are underpinned by POGO clients specifically? What's your outlook there?
Yeah, for the POGO industry, we have heard that some of them, some developers are getting inquiries. Some of them are returning, but definitely not at a large scale as observed pre-pandemic during 2019. So we don't expect a significant resurgence for now of the POGO industry.
Right. All right. That makes sense. Thank you for that. I guess if we can have a last call for questions. While we wait, perhaps a couple of questions would come in. Let's go back to a bit on the analyst side. I guess per your experience, you mentioned a lot of components of valuation. I guess especially the discounted cash flow. And by the way, this is a breath of fresh air in that we are focusing on an analyst perspective instead of the usual investor perspective that are most common among several of these in webinars. Which of the components of valuation do you find like the most difficult to estimate, or maybe the most volatile to estimate, for your experience?
Well, office REITs are somewhat really how you forecast them. The model is quite stable since they do usual they usually come in, they have high occupancies, then you just in pencil in the escalations that you expect, which are more or less contracted and usually regularly implemented by the REITs. There are some volatility involved when you have a REIT whose occupancy is dropping. In that case, then you may have to make your own assumptions on how you expect occupancy to improve in the coming quarters or in the coming years. Aside from that, with the recent VREIT offering, its model is a bit different because of how because the leases are of malls and as opposed to offices, and therefore they have a different way of um, accounting wise. There's a different structure in terms of how they account for straight line adjustments, and that was definitely something more different from the previous REIT issuances that we've had.
Very interesting points. Some things are similar in terms of valuation to, say, property companies, and I guess a few other things are different. I'm not seeing a few more questions, so unless something comes up, perhaps let's end the questions with something like the future of REITs. You've shown a while ago the number of companies right now that have REITs. I think we've counted 7, including Vista REIT. Do you think it's more likely that we see an increase in breadth of REIT, maybe more companies to issue, or perhaps more subsidiaries? Or is it more possible that depth will increase? I've seen earlier that you commented on, like, currently there's no optionality in terms of REIT issuances. Do you see like breadth or depth becoming the future of REITs in terms of the Philippine setting? Or perhaps a mixture?
I think it's a mix. In terms of breadth, we still have companies that have yet to have their own REIT issuances, such as SMPH, and then some maybe smaller property developers are also potential REIT sponsors, such as, for example, BMW, as they also have a portfolio of investment properties that generate recurring rental income. In terms of depth, right now we are really seeing strong push from companies to grow the REITs, the existing REITs. So in the near term, that's where the focus will be. But aside from that, we also have Double Dragon. They also plan to issue another REIT, but this time on V, and they're in their portfolio of industrial warehouses. So it's a bit of both, I would say. But right now, the most aggressive push is really with property developers expanding their current REIT portfolio, the current REIT.
All right, that's I guess we'll just keep an eye on which issuances will come in, maybe this year, maybe next year, or basically it seems that the future of REITs in the Philippines is bright, and as analysts, we will be there to make sure that the valuations are definitely fair, or in that case. So I'm not seeing any further questions, so I guess
There is a question on the chat window about distribution per unit.
Sure. Yes, from Alvin Tan. Could you comment more on distribution per unit?
So this is more or less the amount of dividends that REIT investors per share. So it's more or less the same as dividend per share. So it's distributable income divided by number of shares outstanding. But here in the local REITs in particular, there are some adjustments further adjustments depending on the REIT. No? Sometimes they deduct some capex, maintenance capex that we do. So here for REITs, the final amount that we use is the adjusted funds from operations, which takes into account some non-cash adjustments and capex, capex, expenditures.
Okay. Yeah, that's
Now that Francis brought up adjusted funds from operations, I'd also like to point out, and I think this was Alvin Tan's question as well, about what other multiples that are being used to analyze REITs. Now, one of those is also price over funds from operations, no? So P over FFO. So instead of price over earnings, REITs are usually better measured. Now, if you're going to use a multiple similar to price earnings, are also measured using price over FFO, no, or price over adjusted FFO, as a proxy, no, for price over earnings. Again, based on the idea that funds from operations are the better measure of profitability because it is cash based and it is the basis for paying out dividends.
right. That makes sense. And I think the distinction is also clear in that case. We have one additional question. Are you okay to extend a bit? If there are questions that come in,
Sure. There's no problem.
Oh, nice. Very nice. It seems you have
We
a
have the
very
time.
active audience this time. From
Yeah,
Arlene
I'm
Gonzalez.
actually surprised by the toughness of the questions, no? By the intelligence of the questions. I thought the attendees here are, newbies in the investing market. So I'm quite surprised by the sophistication of the questions. But yeah, go right ahead, please.
Right. I think they mirror the sophistication of the presentation as well. It's analyst focused. Then I guess the questions are also analyst focused. From Arlene Gonzalez, can different types of assets be infused in the same REIT company, or is there restrictions in terms of what can be under a single entity?
I think it really depends on the strategy of the company. We also have the diversified REITs here, such as a REIT which has offices, industrial lots in its portfolio. But then there are companies such as DB which would choose to separate its office REIT versus its industrial warehouse REIT.
Yeah. The short answer is it's possible. But again, companies would have different strategies as to whether they would like a diversified REIT or a more specific asset REIT.
Right. So I guess more or less it's a company decision on whether to do a diversified REIT or a more specific REIT entity.
Yes.
Right. Okay. I guess maybe a last call for questions. I'm not seeing any in the chat at the moment. Again, if you wish to raise your hand, you may do so as well.
I think there were probably some questions which we weren't able to answer, not just because we were rushing through answers. If I recall correctly, there was a question on differing policies on REITs across different countries, like in the region.
Yes. Yes.
Again, unfortunately, as to that question, we need to research on that. No, we have not the opportunity. We haven't had the opportunity to do recent research on that. So we can do that for you and then email you with our presentation material along with the answer to that question.
Yes, please. I think the audience that we have now would appreciate that very much, given that they were very engaged in this particular presentation.
Sure.
Thank you for that. I don't see any other questions. Did we miss any? I think we've covered a lot. So I guess at this point, thank you, Mr. Ruiz, for that.
You're welcome.
And thank you for Mr. Morano. before we end, to our participants and to Mr. Ruiz and Mr. Morano as well, please turn your attention to the screen for the QR code of our online evaluation. For the audience, please take time to answer the survey. It will take you 1 to 2 minutes to complete. So let's perhaps give a minute to everyone. Again, this is, I guess, a more detailed presentation than the usual webinars that we have been seeing regarding REITs. And I think we we need to have both as well, like the more investor introduction to REITs, and then this kind, which is more analyst focused. They serve different audiences. So thank you for this, definitely. All right. So for everyone, hopefully you've captured the QR code. We'll also send it out, the QR code for further evaluation. For now, for everyone who's in the audience, let's turn on our videos for the photo opportunity with our guest speaker for today. I'll hand the floor over to Tricia and Precious, who will give further instructions. So remember to smile.
Can I just say hello to Zaldi Capulong, who's in the audience? Hi, Zaldi.
Hi.
Hi, Zaldi.
Okay, guys, on the count of 3. Okay, smile, ah. 1, 2, 3, smile. Okay, another one. Okay, 1, 2, 3, smile. Okay, thank you, guys.
Thank
All
you.
right. Thank you for that.
Thank you.
Again, CFA Society Philippines would like to thank our sponsors. Our platinum sponsor is Sea Oil Philippines Incorporated. Our silver sponsors are BDO Capital, Coco Life Asset Management Company Incorporated, and FTI Consulting Philippines Incorporated. And our bronze sponsors, AP Securities Incorporated, DPP Daiwa Capital Markets Philippines Incorporated, and Papa Securities Corporation. Event partners are FMAP, MART, and ShareFill. So again, this concludes our webinar. To everyone, the presenters and the audience, we sincerely appreciate your time and effort in participating. Thank you very much and have a good day.
Thank you. Bye.